Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gil Epen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gil@epen.info. My guest today is Professor John Birge, who is a professor of operations management at the University of Chicago Booth School of Business. His work focuses on application, theory, and computation for decision-making under uncertainty, with applications in the management of operations in finance, energy, healthcare, manufacturing, public policy, and transportation. He's an Informs Fellow, MSOM Society Distinguished Fellow, member of the U.S. National Academy of Engineering, and editor-in-chief of Operations Research. Welcome, John.
Thank you. Thanks, Gil.
I want to start with one of your papers, Optimal Commissions and Subscriptions in Networked Markets, where you consider a platform that charges commission rates and subscription fees to sellers and buyers for facilitating transactions, but does not directly control the transaction prices, which are determined by the traders. You say that two salient features of the most online platforms are that they do not dictate the transaction prices and use commissions and or subscriptions for extracting revenues. And you have some analysis around what might be optimum for the platform, right? I know that eBay, for example, charges commissions, but I don't think they have a subscription, right?
Right. Yeah. So on eBay, you're just paying a commission. You're not paying to be like you don't have to pay a fee just to be a member of eBay.
Yeah, and Amazon is sort of a platform too. I guess the sellers have some sort of subscription there on Amazon.
Yeah, I mean, Amazon sort of is a little bit of a hybrid in that if you're a Prime member, you're paying like a subscription, so you're not paying a commission for the things like delivery charges.
And the sellers, I guess, typically pay commissions. And so you want to talk a bit about the paper, what you found in terms of optimality?
Yeah, so the paper was looking at whether these platforms are doing the best thing in terms of the way that they set their prices, and their prices basically being these commissions or some kind of subscription. So you can think of subscription might be like you pay just per ride, like for Uber, if you were only paying Uber, say $5 for a ride, and then everything else was going to the driver, that would be like a subscription from the way we were looking at it.
Oh, I see. Okay. Yeah, so it's not monthly subscription per se, but it's some kind of a constant fee.
Right. It's more like a fixed, right, like a fixed fee. Like it's like the flag fee for a taxi cab.
Okay.
So there's a little bit of that again with Uber. Now Uber's actually sort of separated prices. So the price that you pay as a rider is actually different and doesn't have to be necessarily even related to the value that the driver receives.
Mm.
So they have an even, I would say, even more sort of complicated way of doing it. But generally, the way that they set the commissions doesn't vary by where you might be. So if you're in downtown Chicago and you want to go to O'Hare Airport, you pay the same commission, even though the price might be different, as going from, let's say, a nearby suburb to O'Hare.
Okay, so price might be different, meaning so the cut between the driver and Uber are going to be different.
Well, the commission in the way Uber is set up now doesn't change. So the fraction that the driver receives
Yeah.
is somewhat the same, but that's not necessarily related to how much so there's like a commission for the driver, and there's a commission that the passenger is paying, and those two are not necessarily
Oh, okay. Okay. And so one of the things I think you find in the paper is that it is not optimum to have a constant formula, right, for commissions and subscriptions. It might be optimum to vary that by consumer and seller types.
right. Yeah. What we found is that the platforms could actually drive more business, and it could be both. It could be both beneficial to, let's say, the providers as well as the customers, and the platform,
Mm,
by varying how much they charge in terms of a commission or in terms of some kind of a fee,
mm,
uh, by the different locations. And then what we did is we looked at how would this apply to Airbnb, and we looked at Airbnb in Chicago,
yeah.
and we found that if Airbnb in Chicago had actually, instead of charging a fixed commission, which is the way they charge now,
Mm,
if they had varied that commission by location, they could have increased their revenues, and they also could have increased availability um, for customers. In other words, by lowering the commissions in areas where people wouldn't necessarily be renting a room or an apartment, they could actually drive greater volume,
mm.
number of customers, as well as increasing their revenues.
Yeah, so obviously you cannot vary that by person, but it's you're saying by location, by regions, by perhaps even time that you actually rent it. Those features could suggest a varying rate that might be more optimum.
Right. Yeah. By varying the rates, um, both the platform could benefit, but also consumers could benefit. By, in particular, having lower commissions in areas that people would not necessarily make their first choice. So
Mm,
instead of downtown Chicago, maybe in Hyde Park. So you might have lower commissions in Hyde Park. More people would then prefer to go to Hyde Park, and that might increase the number of people who come to Chicago.
right. And so their data should sort of tell them that, right? Um, do they not use the data that way?
Yeah, they have information about how likely people, and that's basically what we were using in our
Yeah.
study, about how likely people are um, to to use their service. In other words, to get a room or an apartment through them.
Mm,
Um, but they tend to have a fixed commission rate. I
mm.
think mostly just out of simplicity.
Yeah.
But what our study shows is that actually, it they're essentially losing a significant amount of potential revenue, but it also could be better for consumers,
Right.
if they're able to vary what those commissions would be.
Yeah, so certain areas it's all sort of a lose-lose position. Consumers lose out, and they not the platform itself is not maximizing profits. Whereas in other areas, perhaps they're losing revenue, even though consumers might be getting it at a cheaper rate or something like that.
Right. Yeah. That's basically the mechanism behind this. That um, in Chicago, downtown Chicago is very popular. Many people want to stay there. So Airbnb could have a slightly higher commission. Now that's going to mean that fewer people will rent in downtown Chicago, but they'll be more likely to rent in those locations where the commissions are lower.
Yeah. So, John, more generally, are you suggesting then? Obviously we have dynamic pricing. Are you suggesting sort of dynamic commissioning?
Yeah, it's effectively like dynamic pricing.
Okay.
It's yeah, it's changing the commission that's received. Now, in Airbnb, uh, since they don't set the price at all, the price is basically set by the hosts, and then the
Yeah.
consumers either take it or not. Um, so they don't have that price control.
Mm.
Whereas Uber, who is setting the price to the consumer, they can directly set the price.
Mm.
So that is effectively like Uber is determining what the commission is going to be, because they're directly setting the price to the.
They're directly setting the price. So they're practicing dynamic pricing. So if the ratio between the driver and Uber is a constant, they're essentially directing what commission they would pay the driver to through the price.
Right, right, and the way Uber works now is they're basically setting both of those separately. In other words, how much the driver's getting, how much the consumer's paying, those are two separate decisions that Uber's making now.
And Airbnb, more simplistically, they have a commission schedule, and essentially they're just applying that on whatever the hosts are setting the prices for. Uh, and so, wouldn't the host take that into account to set the right price, right quote unquote price, to fill their capacity, or that doesn't happen?
Right, right, yeah. So this will also affect how the host sets what price they would be offering. So if Airbnb's offering a higher, or Airbnb is extracting a higher commission, the host may also want to increase the price, which again would tend to lower the demand there.
Yeah, so I guess one issue Airbnb might have is that the host, if they were to practice some sort of dynamic pricing, that might become maybe too complicated for the host, perhaps. I don't know.
If I guess if the host knew that the commissions in my area were a fixed amount,
Yeah.
then then it would be whatever. I mean, Airbnb has changed their commission rates over time, so they're a little bit used to having some kind of changes.
Okay. Okay. But you're not suggesting dynamic pricing per se. But what you're saying is that Chicago and Hyde Park could have different commission schedules
Right.
based on what they understand from the data.
Right. Yeah. So downtown Chicago and Hyde Park should probably have different commission rates
Right.
based on people's preferences.
And you also find in the paper, John, that there are some sort of interesting pricing issues. If you charge commissions and or subscriptions to only one side of the transaction, you get one answer as opposed to both, right?
Right.
And
Yeah.
what's it? Yeah, go ahead.
Yeah. In certain circumstances, you can just charge the host, for example, or just charge the guest. But in general, it's best if you can apply commissions on both sides. And Airbnb does that to some extent. There is both a charge on the host side as well as on the guest side. But what we found is that by varying, and particularly on the host side, by varying the commissions that they charge on that side, they could increase revenues and actually increase the total number of people who stay.
Mm. And so one interesting thing is you say that if you sort of consistently follow a revenue maximizing logic at the platform level, it accomplishes at least 2/3 of the maximum achievable social welfare as well. So it's sort of a win-win.
Yeah, that's what I was trying to say. That
Yeah.
So consumers and hosts win as well.
Right. Yeah, I want to jump into another paper, dynamic learning and market making and spread betting markets with informed bettors. You study the profit maximization problem of a market maker in a spread betting market. The spread betting is sort of the sports market, I think, right?
Right.
And so in this market, you say the market maker quotes cutoff lines for the outcome of a certain future event as prices, and bettors bet on whether the event outcome exceeds the cutoff lines. And one complication for the market maker here is that the bettors come in two varieties, I guess. There are people who are more informed, doing strategic manipulation, so to speak, and there are more general bettors who don't really have any information, right? So the market maker has sort of an optimization problem taking into account all the participants.
Right. Yeah. So there's the market maker, let's say the sportsbook manager, is trying to gather information about what's the outcome of a particular event, particular game, and they don't know how much, but they don't know how much information people have. So some people might have a lot of information. They might know that a particular player or set of players are not able to play. One example that we had was a game a couple of years ago with the Golden State Warriors, and their stars Steph Curry and Klay Thompson were originally scheduled to play in the game, and so Golden State was favored. But the coach made a decision at some point not to play the two of them. And what we saw is that some people started to bet against the Golden State Warriors. So some people had this inside information before it had been released, and they started to place heavy bets against them. Then the information gets released, and the line of the game changed dramatically. It went from the Golden State Warriors being favored by 9 points to the Golden State Warriors being essentially on the losing end by 5 points. So it changed dramatically when this information was released to the public, but there were some people who already knew it, and so there are some people that have this inside information might be trading on it.
So these are not, John, these are not regulated markets, right? So there are no insider trading restrictions in this market.
There's no kind of insider trading restriction, and that's the role that these managers play. That they're supposed to have the information, and they're supposed to set the lines in a way that everyone has an equal opportunity to win from the game. But in this case, there were some people that had this additional information and started to bet against it. So what we were trying to answer in the paper was, well, how should the sports manager operating a market like this, how should they operate it when they want to learn what people know, but they don't want to actually be fooled? So what we show in the paper is it's possible that one of these informed bettors who has this additional information could actually fool the market maker and end up making a great deal on the game.
Mm.
And so what we come up with is a strategy that a sports manager can use in order to avoid that situation.
Yeah, so I don't know much about this market, but in that basketball game, how far in advance does the market open, so to speak, for something like that?
For most of these games, the market is most intense immediately following the previous game. So in basketball, that usually means 2 or 3 days. For football, it's always 1 week, or essentially 1 week.
Hmm.
For baseball, it could be just 1 day.
It's most intense then, but could
Most intense,
you?
yeah. But the market opens
Yeah.
at the beginning of the season, essentially, for all the games. But
Okay.
there's
Okay.
very little activity until, particularly in basketball and football, very little activity before the week of the game,
Hmm.
because people don't know who's going to be healthy. They're uncertain about the games, uncertain about who will be playing, and are not inclined to bet on those future events like that, unless it's like the championship game.
Right. Right. And so market maker has um, some level of risk if there is an informed bettor in the pool.
Right.
Otherwise, they could basically just assume it's sort of normally distributed, right?
Right. Yeah. They can assume that, and we have some evidence that market makers realize that sometimes bettors are biased for certain
Mm.
teams. Certain teams are favored more than they really should be. And the market makers adjust their odds to try to take advantage of that to some extent.
Yeah.
Um, but they also they try to glean this information from anyone who is informed. So they try to, effectively, they call it the smart money. They try to see what is the smart money doing, the people that might have some additional information, and how can they use that to set their odds so that they don't end up losing substantially.
Mm. Yeah, it's interesting. I don't know if it happens in the US, but certain markets, there is also a problem of fixing the games, right? So
Right,
there has been number of instances in cricket, for example, in
right.
India and elsewhere. I wondered, since these are not necessarily regulated markets, but game fixing obviously is not allowed. Whether this type of data might allow whoever is looking into it, maybe early indications that the game might be fixed.
Yeah, it could allow for that kind of investigation. This is becoming a bigger issue now because essentially now online sports betting is legal in the United States. In other words, there's no federal law against it.
Hmm.
So now it goes by state. Illinois has recently made it legal, so there's been a lot of activity, a lot of advertising for the online sports betting market. Um, Now, in fact, used to be that Nevada, for example, was the biggest state for sports betting. Since this law has gone into place, now it's moved to New Jersey. So New
Hmm.
Jersey has the largest sports betting.
Yeah, yeah. It's and so in the paper, so this is from a market maker's perspective, they have to sort of balance the learning that can get over time by looking at the entire pool of betting, but also you say they have to sort of bluff proof, whatever they actually come up with in terms of the
Right,
spread, right? And so you come up with a family of policies to do that.
right. Yeah, the policies that we come up with are we call them inertial policies. They're
Mm.
basically policies in which the market maker commits to following a certain strategy that's fixed based on what bets there are. Um, and that's different from what we usually think of people should do, which are called Bayesian policies, so that people use the information that they have and they update that information. That's the Bayesian updating.
Yeah.
But if they did that, then they would be susceptible to manipulation. That's the problem. That when you do that, early information ends up having plays a larger role than later information. And so what can happen is that the informed bettors can bluff at the beginning, force the market maker to move in the wrong direction, and then take advantage later when the market maker has more confidence in what they think the spread might be, and that therefore they're more reluctant to move it. Then they can take advantage of that. So by following this inertial policy, they're able to avoid that.
Right. So for my understanding, John, so this is essentially the market maker advertising what their policy is and just sticking to it.
And then sticking to it. That's right.
Yeah.
Essentially saying, here are the rules I'm going to follow, and there's no way, if I follow these rules, that you, as an informed bettor, you can still make money. You can still make money off your information, but you can't make money by fooling me and making excessive profits off of
it. Right. So the informed bettor, I guess the informed bettor cannot see the book, but the informed bettor could see how the spread is changing, right?
Right. They can see the spread changing. Right.
And so can they sort of like you're suggesting, the strategic manipulation, sort of dabble in it, and if it is moving in one direction, slowly nudge it in that direction, and at some point take the other side or something like that. But you're saying if the market maker sticks to the original policy, the chance of that happening is much lower.
Yes, that if the market maker sticks to that inertial policy that we described, then any kind of bluffing, any kind of nudging that informed bettor might make would end up being a losing strategy. So they're just going to lose money by doing that.
Right.
So the best thing they can do is just to whatever odds they have, if they're in their favor, they should bet on that, and that's it.
Right. Okay. I want to get into another paper, a different area. So credit shock propagation along supply chains, evidence from CDS, credit default swaps market. And you say in the paper, using a panel of credit default swap spreads and supply chain links, you observe that favorable and unfavorable credit shocks propagate through the supply chains in the CDS market. It's a very interesting way to look at shocks in the supply chain, right? You can actually see how the risk is moving around in the entire system through the spread.
Right. Yeah, and what I think is I think there are a few things that are interesting about this. We might expect that if your customer has some kind of problem, if your customer is starting to go into default, then that's probably going to be bad for you if you're the supplier. And that's been demonstrated in the stock market. We've seen that if a customer has stock price go down, their miss earnings, then the supplier is probably going to go down. Although it sometimes happens slowly, so that information is actually diffused somewhat slowly. There's a paper by Lauren Cohen and Andrea Frazzini that looked at that several years ago. And they had an example of Callaway golf clubs. And Callaway made a statement that they were going to miss their earnings target, miss it substantially.
Yeah.
So So Callaway's stock went down about 25%. But Callaway's major supplier, Coscas, which makes all the shafts for Callaway, and for whom Callaway represented about 50% of their sales, Coscas had absolutely no effect. So Callaway goes down by 25%. Coscas stock remains constant until about a month. So it takes about a month, and then gradually over the course of the month, Coscas stock goes down by about the same amount that Callaway's did. So they put that paper out. In another paper, I looked at this kind of propagation in the stock market to suppliers, and it turns out that happens to for suppliers as well. So if your supplier misses earnings, it turns out that's bad for your stock price as well.
Right.
And then what we wanted to see is, well, is this true for the CDS market? In the stock market, it looks like it was a little bit delayed.
Yeah.
Although after this Cohen and Frazzini paper, there were a number of funds that were set up to try to exploit this, and essentially the effect disappeared. But
1 month is a long time. Yeah.
Yeah. What we found was that the supplier effect was still there. So the supplier effect was actually still there. We wanted to see if it was in the CDS market as well.
Yeah.
And yes, but it's very immediate. The CDS market seems to react almost instantaneously. That is, if your customer starts to default or starts to have difficulties, so that their CDS value, their CDS spread goes higher, then your CDS spread is going to go higher.
So how do you explain that, John? We tend to think that the markets reflect information reasonably fast. Is explanation for CDS immediate reaction, sort of delayed reaction in the stock market related to liquidity or something else?
I think that the stock market, because that there's more diffusion of the participants in the market, it's not as quick to react. That is, it takes a little bit longer for news to travel, and it's not as transparent. That market, at least, is not as informed about the supply chain relationships that firms have.
Whereas the CDS market, the participants there arguably are more sophisticated,
right?
And can see that supply chain effects a lot faster.
Yeah, and I think they have visibility of the supply chain effects. And what we show in the paper is for firms that have greater analyst coverage, the reaction is faster. It seems like that in the CDS market, the information is traveling quite quickly, and it's traveling in both directions about the same amount. That is, if your customer is in trouble, your CDS spread is going to be affected about the same as whether your supplier is in trouble.
And I noticed a little bit of a difference. I don't know if it is statistically relevant on the customer up jump event, which is an adverse credit shock. 63 basis points move, whereas on the supply side is 74 basis points. Is that difference statistically relevant?
No, those are essentially the same. Yeah, so that's the supplier and customer effect seems to be about the same. What's also interesting is that good news also is propagated. It's not propagated as heavily as bad news, but if someone's CDS spread goes down significantly, then both their customers and suppliers see their CDS spreads go down. Right. And the effect actually goes through several tiers. So not only the first tier suppliers, but second tier and even third tier suppliers and customers have effects as well.
Hmm. Yeah, and you also say that industry competition and financial linkages between supply chain partners such as trade, credit, and large sales exposures amplify the shock propagation along supply chains. So that is fairly intuitive. That's what you would expect to see.
Right.
And so related to that, I want to get into another paper, and this is specific to what just happened to us, the impact of COVID-19 on supply chain credit risk,
Right.
where you examine how supply chain activity reflects into credit risk during different phases of COVID-19 pandemic, again, focusing on the CDS default swap spreads and US-China supply chain links. And so what you mean by two phases is sort of China getting into trouble and getting out of it, and the rest of the world getting into trouble, right? And so you can see
Right.
data in two different horizons.
Right. Yeah. And so what we found is in that first period when the virus, when people knew that the virus had community spread in China. So that's the period of essentially following February 1. Um, and when China started to lock down, and so many Chinese businesses were forced to close during that lockdown period. What we saw is that people or firms in the United States who had Chinese suppliers saw their CDS spreads go up significantly during that period. But then what happened during the period when the virus was spreading within the United States, but while China was actually reopening, what we saw is that firms with Chinese suppliers saw their CDS spreads actually go down. So CDS spreads went up if you had Chinese suppliers during that first period where China was in a lockdown phase. And then they went down during the period when China started to reopen and businesses in the United States and Europe were being shut down.
So from a supply chain flexibility perspective, John, is it? I guess so. If you think about two cases where you have customers and suppliers in a location like China, as opposed to another supply chain where you have suppliers in China but consumers in the US. How would these two networks differ in terms of its its overall risk in a shock?
Well, you actually get exposure from wherever your suppliers and customers are. So the fact that your customers are in a location where businesses are being shut down, that is going to lead to stress for you, and therefore your CDS or your default likelihood is going to increase.
Yeah.
So any of these exposures when there is going to be some sort of disruption in those locations lead to changes in the CDS spreads. So the CDS spreads again react very quickly, and they include that information about your suppliers. I was going to say, but what we also find is that there is moderation, so that if, for example, if I have suppliers in multiple locations, so I might have Chinese suppliers, but I also have suppliers elsewhere in Asia or suppliers from South America or Europe, and then having those additional locations of suppliers actually leads to mitigation of the effects that I might have from China.
Yeah, so that's what I was trying to get to. So if you are regionally organized, where you have suppliers and customers, then a shock in that region, you're going to get a double whammy, right? You're going to
Right.
hit from both sides.
Right.
But if you have a supply chain that is sort of, spread out, what you're finding is there is a lag in that shock traveling in that supply chain. So, from a policy perspective, from a management decision perspective, the that duration for that shock to travel, does it actually give you some additional leverage in terms of managing the business, or not really?
It it might give you a little bit of warning. If you're in a business where you can find different suppliers, and we tried to look a little bit at that in terms of flexibility. So people that have flexibility,
Yeah.
who are able to find different suppliers, um, it seems like they're less affected. Yeah. So the fact that I have a distant supplier, they have a shock. I know that that's going to take some time to actually affect me. Um, if I'm in a business where I can find different suppliers, then that effect goes down, and CDS spreads appear to reflect that.
Mhm. Yeah, it's interesting. This pandemic is sort of shocks traveling back and forth in some ways, right? Now, US has a shock that is going to slowly travel back to China.
Right. Yeah. Yeah. It's been an interesting process to see how these shocks are being transmitted. Again, what I found interesting about this is the the sophistication of the CDS market. I think
Mhm.
the CDS market is very much aware of what these different businesses do. We saw that, for example, that firms that have greater exposure to the household channel, well, it depends on what kind of things we're providing to the household channel. If you're providing things like staple products um, that weren't really affected by the lockdowns, then that was again a mitigating factor in terms of your CDS values. But if you're providing things that people don't necessarily need to buy, like electronics, then that had you had more of an effect from the
Mm.
lockdowns.
So, so in conclusion, John, so pandemic is still around. Who knows what's going to happen? We might have a COVID-20 behind COVID-19.
Right.
Um, what would you, based on your research, what would you say, from from a company policy perspective, how to best think about organizing your supply chain? What would be the dominant way to think about it?
I think having flexibility is one of the biggest things that firms might be able to do. That is making sure that you have alternative qualified suppliers um, and suppliers in different regions. Um, if you can pick up on suppliers in different regions of the world, then you'll be able to react to conditions that might be changing in those
Yeah.
different locations.
Is there any kind of capital structure issues that firms might have learned from this shock?
Yes, we also saw that firms that had greater cash, firms that had lower leverage, um, they were less exposed to the issues um, from these shocks.
Right.
So it suggests that uh, that firms need to, in their risk management, they need to be planning about these events. I mean, this is what I'm not sure if it's really once a century. It might be a once every 2 decades kind of
Right.
thing.
Yeah.
It's I mean I think it's more. I mean, particularly if everyone from a disease point of view, I think it's actually more like a once in 2 or 3 decade event.
Mm. Mm.
Uh, in which case, if people are going to react to events like this, then businesses have to be prepared, and that should be part of your risk management strategies.
Yeah, there's always a cost to it, and so
yeah, there's a cost.
yeah. And I also wondered, so CDS works very much like an insurance policy, right? So whoever is on the other side of the transaction also has the same information. So the spreads are efficient, I would imagine, right?
Right. Yeah. That's one of the reasons why we like to look at these CDS markets, because each party actually is really trying to uh, offload risk or incur risk, but
Yeah,
incur it in a way in which they think they're being fairly compensated.
right.
Uh, so there's, in other words, I think there's relatively little speculation in the CDS market. So it
Mm.
seems to be more driven by risk management practices, and therefore um, not as susceptible maybe to sort of speculative um, activity that you might see in other kinds of markets.
Do they look at a company's CDS having more diversifiable risk? And so if they're practicing portfolio management more traditionally, and you have a lot of different industries, a lot of different size of companies, presumably you have some diversifying risk away. But this is a systematic shock, and
Right.
it won't work in that case.
Right. Yeah. So that's one of the issues with CDS is tail risk,
Hmm.
and tail risk is quite different from um, the standard market kinds of risk.
Yeah.
So tail risk is very correlated, right? So yeah, so that it's often quite systematic in its or systemic in its effect.
Yeah, so if it is systematic, then the advantage the providers of the swap has is just capital. What other advantage might they have?
Yeah, no, it's just capital.
Okay.
Um, yeah, and that's, I mean, and so if they don't have capital, that's why these markets can collapse, and that's why we had a lot of issues in 2008 when people
Right.
were putting these all together
Yeah.
and putting them together into securities.
Right. And so the buyers have to be aware of that as well, right? There
Yeah,
is
the buyers have to be
counterparty risk there as well. Yeah.
right.
Excellent. Thanks so much, John. This has been great. Thanks for spending time with me.
Yeah, thanks,
Um,
Cal. Thanks. It was great talking with you.
Thank you.
Thanks. Take care.
Bye.
Bye bye.